Yeah, without question there, Peter. And, if you're a true investment advisor, you want to look at all of the solutions that are possible for your clients. There, you're acting in their best interest.
And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for our money, our finance, our investments, and our retirement future. He is president and founder of McIntire Retirement Services. Always a pleasure every time we get the opportunity to join Chris McIntire here on your game plan for retirement, ladies and gentlemen. If you've got questions, always looking forward to hearing from you. Welcoming your calls, 419-332-0532, 419-332-0532. Chris, a very special weekend here, the 4th of July holiday weekend, celebrating our national independence. And I feel like the advice, the theme of this program always coincides with this holiday because you try to give people lasting financial independence, personal independence, and confidence. And so while we celebrate the nation's birthday and our independence, ladies and gentlemen, that's always the premise of the program. And Chris, you do a great job in helping people remember that this is a great nation. You always remind folks at the end of the show, but also helping people structure those plans for the true celebration of independence, and that is to have personal financial confidence and freedom.
Yeah, absolutely, buddy. And we're proud to do that in this great country that we all live in. And hey, freedom also allows you to voice your discontent, and we see that as well from time to time. And but that's what freedom allows. If you weren't allowed to voice your discontent, you might be thinking we live, in Russia or something
Yeah.
along those lines.
We
China,
need that.
for
We
example.
we, we need it. We
Yeah.
need civil, with courtesy and respect, but be able to voice differing opinions, hear them out, or I always tell my team and my wife that if everyone always agreed with me, I wouldn't really need anyone else, right? It'll only be my opinion that matters.
You're right, Peter. So, civil discourse is what makes it go round. Not everybody's right all the time. And, it would be nice if some of that started at the top and came down, maybe in the halls of Congress. If we could see a little bit more bipartisanship there, it would probably spread into the rest of the population. And let's hope and pray that we get there sooner rather than later.
Yeah. Well, Chris, we always appreciate your perspective, your time here on this holiday week. Again, ladies and gentlemen, have a safe, happy, healthy 4th of July weekend here celebrating our freedoms and our independence. And Chris McIntire is here after the holiday to make sure that every day is a celebration for you with your personal independence, your financial independence, structuring that game plan for retirement. If you've got questions, concerns, if you'd like to look over your investment portfolio, your retirement accounts, and get your plan put together, or just double check the plan that you have, feel free to give a call, 419-332-0532, 419-332-0532. Now, Chris, last week on the program, we talked for a minute or two about the interest rate environment. And we talked about the fact that a lot of people right now are feeling a little concerned with the stability of the markets, with the volatility that we've seen with everything going on in the world. And this week on the program, going to talk about some alternatives to that, and specifically where we can get certain guarantees for our money, but still have the opportunity for forward progress. And one of the tools that can offer these balancing qualities that seem to be opposed elsewhere are annuities. And I know annuities have been debated, but they certainly have had a surge in popularity, as for the last 5 years, we have seen record deposits and purchases into annuities. Why are we seeing this resurgence in the popularity of annuities, and what can an annuity do for us, Chris?
Yeah, yeah, good point. Good topic to talk about here today. It's probably one of the most misunderstood investment vehicles that are out there, and a lot of bias inputted, right? If we all question the media bias sometimes, right? That's been a popular talking point with the current administration in there, and
Sure.
there's certainly a lot of media bias in the in the annuity space as well, and partly because of what they represent. Okay, so let's talk about the good, the bad, and the ugly. So, annuities are a contract with an insurance company that, in very simplistic terms, can give you an income for the rest of your life, no matter what the balance of the annuity is, right? Nothing else does that. When your brokerage account at one of the big firms, or, we use Charles Schwab and Fidelity. So when those accounts are at zero, that's it. In an annuity that's you've signed up to get a guaranteed lifetime income for you and even your spouse. Okay, that's a contract with an insurance company, and they're backed by the claims paying ability of the insurance company, and plus some other safety elements that are behind the scenes in there as well to give people peace of mind. But nothing else on the planet does what an annuity can do, right? I mean, nobody says, I don't want my Social Security because I don't like annuities, or I don't want my pension payment because I don't like annuities. And so let's go through this here, Peter, if it's okay. There's, breaks down to a couple of basic different types of annuities. Okay. There is an immediate annuity, which simply means it's like your pension. You're giving up a lump sum of money to get an income for the rest of your life. And that's where a lot of people will say, well, I don't want to use an annuity because if I die, the insurance company is going to keep my money. Okay. Well, that really dictates just from an immediate annuity, which is like what Social Security is, right?
But
You
but
die, the
but the
payment
income
stops.
begins immediately, right? Hence the name.
Yeah, yep, yeah. The income begins immediately, and we don't use those very often, to be honest with you. I couldn't tell you the last time we used one. Okay. Now, so that leads us to the deferred annuities, where I'm deferring when I'm going to take income, or maybe I'm not going to take income at all. I just want to put my money there for tax deferral, or, many of the other reasons, safety of principal. So on the deferred annuities, Peter, we go from variable to fixed. Underneath that fixed element is fixed interest rates, like we talked about on the last show, where you could make, a guaranteed interest rate for a certain number of years, or an index annuity, a fixed index annuity, where you want your principal to be protected and have your earnings linked to the performance of a stock market index.
Are the ability for those to grow going to offer people what they need on growth of their money, Chris, or because there's safety, we give up a lot of that upside?
Yeah, so on a variable annuity, Peter, you're directly invested in mutual funds, typically, with stock and bond investments. So you have ups and downs of the stock market there, and hence the word variable is probably a good analogy. That means my principal can be at risk.
So
On
not safety. Like another important differential with the different types of annuities, not safe and protected there.
Yeah, absolutely. And that's where people get confused because they lump them all in together. And, it's like saying, you never want to own any bonds. It's like, oh, God, the bond market's so big, you can't just make that blanket statement. Same with the annuity side. So on the safe annuity side, you've got your fixed annuities that pay a guaranteed interest rate for a certain number of years. In our practice, we typically use those in 2, 3, or 4 year time segments, sometimes 5 years even. Okay. The index annuity, where people want to get potentially more growth based off the growth of the stock market, but they also want their principal to be protected. And a lot of times that they might not have any fee structure with them whatsoever, right? You're giving up, if you're going to give the insurance company the money for 4 or 5 up to 10 years is most common, right? In Ohio, no annuity can be longer than 10 years before you could pull all of your money out of it. So we're a 10 by 10 state, no more than 10 years, no more than a 10% charge to get out of it.
Now, important note there, Chris, is that for a long time, I feel like the perception of annuities was that of the pension from your company or Social Security. After you start taking the income, that's it. Like the income's fantastic, but there's no longer any access to the underlying lump sum. That is not the case, it sounds like, with annuities, where in the state of Ohio, a maximum of 10 years before you could walk away with all of your money penalty free in these type of annuities.
Yeah, yeah, absolutely. And I mean, we deal with that, and you have beneficiaries, so avoids probate. So, you can do a lot of things with an annuity. that isn't even related to getting the income out of it, right? I just want my money to be safe. And if, so for example, we had somebody with, say, $1 million, easy number to use here on a radio show is, and we put $700,000 of that into an investment portfolio, okay, to stocks and bonds to get, higher growth and all that over time, okay, and then maybe $300,000 into a 7 year annuity, index annuity, let's just say, okay, and maybe they can make the first 7 to 10% of the growth of the S&P 500 in that regard. And if you look back historically, okay, more times than not, the S&P 500 is positive of in some number. Okay. So, you put $300,000 in there, maybe you made 5% the first year, you made $15,000, it's in your account. You can't lose that or your principal that you put into it, regardless of what the performance of the market is. Okay. And let's say you don't need it for income, but doggone it, the market went down the next year 25%. So your investment portfolio suffered a loss and you want to make a withdrawal to go down to Florida for the winter. Okay. Yeah, then you go over to your annuity and say, hey, I can withdraw 10% of the value of my annuity. I don't need it for a monthly income. I just need it as a hedge to protect my stock market pieces. So in that regards, you take a 10% free withdrawal, whatever the value is, and call it, say it's 300,000, you pull out 30,000 monthly, break it down into monthly payments, quarterly payments, annual payments, whatever. Or and you go down to Florida, or you take that 10% withdrawal and put it back into your investment portfolio because the stock market dropped 25% and you want to buy low. Okay. So a couple of different elements there to use it from that I'm sure most of the people listening to today never even gave that a thought.
Again, we're talking with Chris McIntire. We're talking about annuities on the program today. If you've got questions, if you'd like to find out more, if you'd like to see how these products may benefit your total financial picture, whether that is safety for some of your money and assets and investments, whether that's the potential for growth, whether that's the income producing power, accessibility factors, all of the above. If you'd like to find out more about them, pick up the phone. Chris McIntire has access to many, many, many different companies and products and can help shop to find the best rates for you and your purposes and your situation. 419 332 0532, 419 332 0532. I do want to emphasize, Chris, that these are not your only solutions. You've got access to the full spectrum of the financial market, the stocks, the bonds, the mutual funds. In fact, I think on the program, we spend most of our time talking about the investment side of the financial equation, but this is another perspective and another tool that is out there that, we shouldn't just write off a tool altogether and say that is not appropriate for any situation. Each tool has a time, a place, a specific purpose that it can serve.
Yeah, without question there, Peter. And, if you're a true investment advisor, you want to look at all of the solutions that are possible for your clients. There you're acting in their best interest. If you're going to say, well, nobody should ever own an annuity, boy, you're really doing a disservice in my opinion, right? Because the number one concern for the retirees are, how do I not run out of money?
Right.
Okay?
And wouldn't that be the same as saying, well, a stock can lose money. Therefore, no one should ever be in stocks. Just you can't just blanket statement any financial vehicle. And in fact, in order to achieve most people's goals, you need a well-rounded variety of different financial vehicles. Some bank money, checking savings, maybe some CDs for a little more growth, but not a very long commitment. Maybe some annuities are in there, some stocks, some bonds, some mutual funds, right? Real estate is part of most people's financial picture, even if it's just the roof over their head, their primary residence. I want to get back to some of the misunderstandings about annuities, though, Chris, because it sounds like you mentioned taking a 10% free withdrawal and maybe using that for the winter down in Florida or whatever, maybe reinvesting. A lot of people, I think, have the understanding that annuities don't have that kind of accessibility. The way you described it, it sounds like there's a fair amount of accessibility there.
Yeah, absolutely. And, many annuities allow, God forbid, should you pass away in that, say, a 10-year annuity, If you passed away in year number five, typically the full value is available to the beneficiary, the spouse, the kids, that type of thing. If you went into a nursing home, a lot of times you can access sometimes all of it, depending on the company, sometimes a good portion of it if you went into a nursing home or a terminal illness. And, some people just, we use them a lot. Some folks, we need that extra income coming in, right? That's what they have to have. And then other folks, look, we're just using it as a hedge over here in case the stock market goes down. And, for the person out there that's thinking, well, geez, why would I put my money into something that I got a surrender charge to get it out of? Okay. Well, it can waive the fee too, right? The management fee. If we're using some of the annuities that we use, yeah, we earn a commission from the insurance company. If we manage money at Schwab or Fidelity, right, we earn a monthly management fee off of that. So sometimes people just want to, reduce. They say, look, I don't care what the insurance company pays you as long as I'm not, right? That's the mentality. We certainly have that available. Um, and then, sometimes we move annuities into new ones that have better opportunities, right? If you're looking back 6, 7, 8 years ago, right, interest rates were next to nothing. Okay. And you look at what's available now, so we do some rotations and whatnot as well for clients to help improve their position. That's a win-win situation.
Chris, a lot of people over the course of their working career have enjoyed their 401ks, utilized their 401ks, and appreciated one very attractive aspect of the 401k, which is the company match. When we put in money, we receive some kind of match on it, whether it's a dollar per dollar or 50 cents on the dollar or 10 cents on the dollar. Some of these annuities actually include a similar kind of feature. They not dollar for dollar, but some kind of match or bonus on the deposit that is made into them. Do you utilize some of those bonus features on annuities ever?
Oh, absolutely. And most of those are on, 10-year annuities basically, because you're giving up some time frame, so they may give you an additional bonus in there. And some of those can be pretty substantial as well. And, some of them have some restrictions on when you can use the bonus. It's again, there's so many different companies out here. We just can't lump them all in together and say, well, they all work exactly the same because that's not fair. They do not. And, so if we move in somebody from like I don't use the variable annuity side of things, full disclosure. It's just not something that, I'd rather manage the money at Schwab or Fidelity and, in an investment portfolio and get rid of some of the expenses that come with a variable annuity, right? Where the fixed or the index annuity, we're using that as a safe money option. And then also, using money market accounts, like you said, Peter, and investment portfolios, it's certainly not, put all your eggs in one basket. And, there are, some advisors or agents, if you want to, that's all they do is the annuity side. They don't do full money management and whatnot. And, I mean, you can't hardly call yourself an advisor if all you do is, sell annuities, for example. And, I mean, I use the index life insurance side. That's where I fund assets. So, we have index annuities that are safe. We have index universal life insurance, and I use that and fund, put a significant amount of money in that for the same concept. It's safe.
But Chris, if we make a deposit and day one there's more money in our account than we put in, I mean that's a good start, right? We're starting on whether it's a 5%, an 8 or a 10% bonus match on what we deposit. That can either make up for losses or perhaps even help recoup something that we've lost somewhere, maybe on a Roth conversion where we're using that bonus to offset some of the taxes that we would pay. I don't know, man. You probably many examples of where people would want more money in their account. However, I say all that to say, kind of a word of caution. I hear commercials out there pitching the bonus as the selling point. And I think that we should take a moment to talk about that because what happens in a vehicle that you do have a commitment period for, whether it's 5 or 7 or 10 years. Like if you've got that kind of commitment, what happens on day one may not be the most important thing. You should probably dig a little further beneath the surface than just what happens with a bonus, correct?
Yeah, yeah, good point. There's when a steak is sizzling, that sizzles really smells real good, but you don't know until you take the first bite of it if the steak is itself any good. So, and so we need to watch, if somebody is all they're offering is, oh yeah, you got this big bonus here, it's like, all right, well, what does that mean going down the road here? Am I getting so much up front I don't have anything in it over the long haul? And with time and experience and wisdom certainly helps advisors, pick and select good quality products for their clients.
Well, again, if you would like to explore annuities, if you would like to shop and make sure that you've got the rate and the product and the features that fit your needs and help you meet and accomplish your goals, if you are looking for safety of your principal with the opportunity for growth, if you're looking to guarantee yourself an income from an amount of money and make sure that you've got the confidence that that will last with guarantees for lifetime income, these are just some of the features and qualities that an annuity can offer as part of your financial picture and portfolio. And Chris McIntire has access to many, many, many of them and can help you shop around and make sure that you are selecting the right product with optimal rates. Give him a call, 419 332 0532. 419 332 0532. 419 332 0532. Chris, you mentioned the healthcare aspect of annuities, and I want to circle back. I think that's a very important topic because a lot of people do not have any kind of plan for healthcare expenses and the potential for long-term care. Getting long-term care insurance can be either health or cost prohibitive. It's very hard and difficult and expensive to do. Um, can annuities offer us at least some amount of protection and leverage against the potential catastrophic cost of healthcare?
Yeah, absolutely. And it's kind of a hybrid long-term care plan, if you will. So I got a good buddy of mine that he said, hey, he says, I'm looking for long-term care protection. I don't want the traditional long-term care insurance. What else have you got? Okay. And so we found him a good quality fixed rate annuity. Okay. It was paying 6% interest. Okay. He plopped in, a specific dollar amount. So I'll just use a hypothetical. Let's say he put in $100,000. He's making 6% on his annuity. Okay. And, so now he's got a growth aspect to it. And then what the insurance company did is say, hey, if you need to use this for long-term care inside a nursing home, we're going to take your $100,000. We're going to run another calculation over here and give you $200,000. Okay. Because you're going to need this to take over time. And man, it really was a very good account for them and what it was going to do for them and the amount of money that they would have available by the time like they're in their mid 80s, because the average age of claim for long-term care is about age 80 to 83 years old here, depending on males or females. And so we build it around, look, what's this look like at age 83? And it was a significant amount of money there. Now, if they never needed it for the long-term care, they got their annuity plus the growth on it that will pass down to their beneficiary. So, that's killing a couple birds with one stone, if you will.
And Chris, the rates for the potential for growth or the potential for future income payouts actually very attractive right now when you look at comparisons. I mean, for 35 years or so, Wall Street has been telling us that we should be satisfied taking a 4% cash flow and hopefully not running out of money. Many of today's lifetime income annuities around that retirement age are paying out higher cash flows and guaranteeing that we don't run out of income from a finite amount of money that we've got saved and invested at the time.
Yep, absolutely. And, we've done a lot of case design for lots of clients and prospective clients over the years. And, oftentimes if somebody comes in and again, we're using that $1 million here just because it's an easy number to work with. And we say, okay, well, I need, X number of dollars for income. say, okay, well, how much of this can we carve off and put in an annuity and maybe get a 5 to 7% payout on it? Okay. So if it was $500,000 at 7%, that's $35,000. Okay. Guaranteed income payments for the rest of your life. Okay. We don't need the rest of the portfolio to do all of that, right? $1 million at 4% is 40,000. Okay. If you had, $600,000 with a 7% payout, that's 42,000, and you just freed up the other $400,000 to do what you want.
Yep.
Okay.
You doing more with less. That's what it's right about efficiency and leverage.
Yep, exactly. And if you look at people complain about the surrender charges and whatnot sometimes, or bring that up as a sticking point, fair point to bring up, no doubt, because if you need liquidity, these aren't the instruments to use for the money I need next year. That's where your money markets and checking and savings and CDs, those things come into play there. Okay. But if you're an investor in the stock market, for example, in 2022, hey, Amazon was down 40% in 2022. So, tell me about surrender charges there. State of Ohio, it can't be more than 10%, but you invest in the wrong stock and it could certainly be a heck of a lot more than that. So, that's not necessarily a fair argument.
Yeah. Well, I know people are worried about their money, different aspects of it, the risk of the market, the volatility, losing value, certainly a big one, generating income from their dollars for retirement, another aspect. And there are certain tools out there and available that can help you address those concerns, ladies and gentlemen. Annuities are just one of the financial tools. In fact, there are many different types of annuities, but one category of the financial tools that are out there, but potentially worth exploring. Keep an open mind, and Chris McIntire, again, full access to the spectrum of the financial world. He is an investment advisor representative, can help you to structure a plan with stocks, bonds, mutual funds, ETFs, all of the investments in the market, but also has access to the side that you can have safety and security and guarantees and lifetime income. And you probably need a little bit of both for a well-rounded, full, and complete, comprehensive financial picture. So if you are looking to optimize your planning, if you'd like to get that game plan for retirement put together, if you'd like to have a conversation and find out more about what an annuity could offer or how you can manage your money more efficiently and effectively, pick up the phone, give Chris McIntire a call, 419-332-0532, 419-332-0532. Chris, always a pleasure having you here on the program. Happy 4th of July weekend to you. Happy Independence Day. We always appreciate having you here on the program, helping remind us what we need to be doing personally to remain financially confident and independent.
Yep, my pleasure. Yep, be safe out there, everybody. Travel safely here this holiday. Thank you.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any bonuses mentioned may be subject to additional restrictions and regulations based on the offering annuity company. You may not receive the bonus if the contract is fully surrendered or if traditional annuitization payments are taken. And if the policy is partially surrendered, it could result in a partial loss of bonuses. Because these are bonus annuities, they may include higher surrender charges, longer surrender charge periods, lower caps, higher spreads, or other restrictions that are not included in similar annuities that don't offer a bonus feature.